won't believe what you'll see in the next 10 minutes. Imagine receiving your CPP and OAS payments completely tax-free. But stay tuned to the end, because even if you're not planning a move right away, the process in this video could help you to better understand how to maximize your retirement income in any one of the 94 countries that Canada has a tax treaty with. I'm Joe Macek, investment advisor and portfolio manager with IA Private Wealth and IA Private Wealth USA. And in this video, I'm going to show you step by step how it's possible for you to receive your CPP and OAS payments tax-free while living in the United States. Let's jump in. As of 2020, over 800,000 Canadians have made the leap and relocated to the United States, with more joining every day. Why? Because the US is the top retirement destination for Canadians. It offers better tax treatment, especially on your CPP and OAS payments. How special is it? Well, as we scroll down the list, you will notice that out of all of the countries that we have tax treaties with, there are only 3 countries that have the possibility of not withholding any taxes from your CPP and OAS, and the US is one of them. The other 2 are the UK and Brazil. And for the next 9 minutes, I'm going to personally walk you through step by step what happens when you retire abroad from Canada into the US. But who am I and why should you even listen to me? Well, the short answer is, out of the literally thousands of financial influencers on YouTube providing financial advice in their content, the vast majority of them not licensed. Whereas I am a fully licensed fiduciary advisor registered in Canada and the United States. So you've made the big decision to move permanently down south. It's an exciting time, and like many Canadians, you've probably contributed to CPP and are entitled to OAS benefits. Now that you're making the move, you might be wondering, how will this work in the US? After all, taxation on CPP and OAS in Canada is pretty straightforward. They're treated like regular income. When you receive your CPP and OAS here, they're added to your total income for the year. Then, depending on your overall earnings, you pay taxes accordingly. Let's break it down with a simple example to make it easy to follow. Imagine you're retiring in Canada at 65 with no other income. You receive the maximum CPP payment of $16,375 in 2024 and the maximum OAS payment of $8,560. That totals $24,935 in annual income. How much will you pay in taxes? Well, let's find that out. Both CPP and OAS are fully taxable, so your taxes are calculated on the total income of $24,935. However, there's a basic personal amount of $15,705 that every Canadian is entitled to, which reduces taxable income. Since your income in this example is well below that threshold, we know that $15,705 isn't going to be included for that taxable amount. How much tax is payable? Well, if you Google search Joe Macek or visit my website at joemacek.com, you will find a range of useful tools, including a handy tax calculator. And for this example, when you enter $24,935 as your income, the maximum CPP and OAS earnings for 2024, and set Manitoba as the province, it will show that your tax liability in Canada would be around $2,373. However, it's critical to remember that tax rates vary by province, and as you switch from province to province in the calculator, one thing becomes abundantly clear. In Canada, there is absolutely no escaping provincial taxes. Whether you're in British Columbia, Newfoundland, Ontario, or anywhere else, you will face both federal and provincial income taxes no matter where you live. Every province and territory in Canada imposes its own provincial income tax. This is not, as we will soon see, the case in the United States. Unlike Canada, where every province and territory imposes some sort of income tax, several U.S. states do not have a state income tax at all. Residents in these states only pay federal income taxes. And U.S. residents, along with Canadian residents on both sides of the border, generally really love hitting the like button for the YouTube algorithm, as it really helps out my channel. When looking at my metrics, over 90% of the watch time is generated by viewers who are not subscribed. So if you like how I snuck this shameless plug into the video, please consider subscribing, as it helps my videos reach many more viewers. Viewers like the ones we were just talking about in the US that are lucky enough not to have a state income tax, such as Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. 2 more states, New Hampshire and Tennessee, are currently tax-free for earned income, but they do have a tax on dividend and interest income. However, these states are expected to completely phase that out and become income tax-free by 2025. So why is all this important? Well, Canada and the US have a tax treaty for your CPP and OAS and Social Security benefits. You can find the details on the Government of Canada website, and it shows the various tax treaties with the various countries as I scrolled through earlier, including the US. It's also described on the US Social Security site as the totalization agreement with Canada. But not all tax treaties are straightforward. Choosing your retirement state wisely is critical because while most states recognize the tax treaty with Canada, there are some exceptions. For example, California does not acknowledge treaty benefits for CPP and OAS payments. Additionally, states like Alabama, Arkansas, Connecticut, Hawaii, Kansas, Kentucky, Maryland, Mississippi, Montana, New Jersey, North Dakota, and Pennsylvania also do not honor these treaty benefits with Canada. So even though most states, including California, don't tax Social Security benefits, California will still tax your CPP and OAS payments because it doesn't recognize the tax treaty. Unlike Canada, where benefits are taxed provincially in every province, choosing a tax-friendly state in the US and understanding these nuances can significantly lower your tax obligations during retirement. All right, now that we've picked a tax-friendly state for retirement, let's dive into how these payments work. When you retire abroad from Canada to a US state and become a permanent resident, you can have your CPP and OAS payments sent directly to your US bank account by the Canadian government. This is generally viewed as a smart move as it offers a very favorable exchange rate, helping you save money on currency conversion compared to handling it yourself in Canada. What's more, there are no Canadian withholding taxes deducted at source from your CPP and OAS payments when received in the US. This means that your full CPP and OAS payments are converted and transferred to you without paying any taxes in Canada, helping to ensure that you're going to receive your full retirement income promptly and efficiently. Now, I'm not a cross-border accountant, but from what I understand, if you're only receiving CPP and OAS payments in the US, like in our example, you probably do not need to file a Canadian tax return. This is because the tax treaty between Canada and the US doesn't withhold taxes on these specific payments, and there are no taxes owing. However, it's crucial to verify this with a qualified tax advisor or an accountant who specializes in cross-border taxation to ensure that you comply with both Canadian and US tax laws. Okay, so now you have your CPP and OAS payments in your US bank account. It's been received without paying any Canadian taxes, and it's been converted into US dollars at a very favorable exchange rate. Let's now explore how these benefits work from a US perspective. And what many people, along with some accountants in the US, might not fully realize is that CPP and OAS payments are to be treated as Social Security income on their US tax return. That's right, your CPP and OAS essentially is transformed or becomes Social Security for tax purposes. Many US accountants often misclassify these payments on US tax returns as other income or pension income. This is a pretty common error, and it can be costly because Social Security benefits receive special tax treatment. Only 85% of your Social Security benefit is included for US federal income tax, which means 15% of Social Security payments are tax-free under federal rules, and depending on your filing status and income level, you might qualify to have up to 100% of these benefits completely tax-free. Now, I'm not going to get into the nuances and details of how your Social Security is taxed in this video, as I've dedicated an entire video on my US channel that covers this topic in depth, and as this is my Canadian channel, it's kind of outside the scope for this video. But if you're interested in how Social Security gets taxed, or if you're from the US or have cross-border needs, you can feel free to check out my affiliate channel at Joe Macek USA for US retirement planning content. I will leave a link in the description below if you want to watch that video and learn exactly how Social Security is taxed, along with almost everything there is to know about provisional income, what's included, and all that jazz for taxation purposes. Now, just because I won't go into the details doesn't mean that I won't show you a quick example using an online Social Security calculator. We'll convert your CPP and OAS income into Social Security money and then use a US provisional income tax calculator to see exactly how your benefits might be delivered tax-free. Now, as we can all remember, the Canadian government has successfully transferred a total of $24,935 Canadian for the year, converted it into $18,217 US dollars, and deposited it as income into your account. According to this online Social Security benefit calculator, and remember, this is just a tool for a quick quick demonstration of how Social Security benefits are taxed in the US, and it's not meant to provide tax or legal advice. But we will start with the converted amount of CPP and OAS totaling $18,217.57, and let's see how this income is treated under US tax regulations. Let's use a round number to illustrate the inclusion rate. If we input $10,000 into the Social Security area of the calculator, and then we add some large income amount, say $100,000, you'll quickly see that $8,500 of this amount is subject to federal income tax. That's 85%. This doesn't mean that the tax rate is 85%. It just means that 85% of your Social Security income is included for federal tax purposes. The key difference here is that in Canada, 100% of your CPP and OAS is taxable. In contrast, in the US, only up to 85% of your Social Security income can be taxable, leaving 15% tax-free. Now, if we input the $18,217 with no other income, you'll quickly see that none of it is included for federal income tax at all. And if you live in a state where there is no state income tax and honors the tax treaty with Canada, you can easily see how you can get your CPP and OAS payments, 100% taxable benefits in Canada, completely tax-free in the United States after being converted into Social Security. Of course, again, if you have any other significant sources of income, which, let's be honest, is likely to be the case, you're probably going to pay some tax. But I thought this would be a really cool video to show you the process of how you can actually get your CPP and OAS tax-free in the US when it's fully taxable in Canada. Here's the bottom line. Retiring abroad offers a great opportunity for Canadians to potentially receive tax-free CPP and OAS payments in the United States. Choosing a state that respects the tax treaty with Canada is key to enjoying these benefits without additional taxes. States like California and others may not honor this treaty, so it's important to choose wisely. Understanding these details can help you minimize taxes and maximize your retirement income. Do you want to know if you lose your CPP and OAS when you retire abroad? Or maybe you just want to learn more about my latest upload? Well, I've got everything all queued up and ready for you. Click here for more amazing financial insights. I'll be waiting. We'll see you soon.